I want to dig into some of your individual picks, the ones that have paid off well of late. You're a bond man. EnQuest is one of your likes, an oil-related company. Interestingly, it's falling today on the back of a deal with Dalek hasn't gone through. It would seem they were looking to sell a 20% rights of a field that they owned in the North Sea to Dalek. How much do these individual news points move the base when it comes to bond market picks? Or actually looking more at the oil circumference and the company's underlying business?
I was looking for that Dalek deal getting done, to be fair. I think it's important for them. They need to be continually reducing their debt pile, which has been getting bigger and bigger recently. However, for us, EnQuest is all about project delivery. The big Kraken field that's coming on board for them next year in the North Sea, continuing to move towards first oil for Kraken. That's the real key point for our investment in EnQuest and why we think it should pay off for our clients next year. The news flow around Dalek and the short-term oil price is going to push the equity around. But for the bonds, they've been pretty static now for the last month or two, moving around a little bit, but not much. It's not one that we've got a big position in, but it's one I think that's a key risk for us going forward. But it's a risk I think we're quite happy with that payoff coming through from Kraken.
Just to put what's happening today, this 4.5% move, in a little bit of context for everybody. This is EnQuest, the white line here, and this is the dip we're seeing to 26.75. As you can see, the stock, in terms of the move today, not really moving the dial. And as Luke pointed out, this is the correlation with the oil price. That's the Brent price. And as you can see, the curves pretty much kind of almost matching each other, tick for tick up here. So what do you think of the oil price, then, if that's what's happening?
Well, it's stabilising. I mean, OK, it's these big moves percentage day on day, but this is not $120 oil anymore, no. And it's not $20 oil anymore. So if we're in this range of $40 to $50, these companies start making money. They've cut their costs massively. They're lifting it out the North Sea now at $29 to $30 a barrel. So anything much above that, actually, they're cash positive coming through. That's the good thing about oil and the restructuring of the cost base for the oil industry. We were talking off camera earlier about Aberdeen and how difficult it is for people up there, but you've seen those cost base hit really hard, some of these oil centres, but it does profit these companies now to pull oil out of the ground.
Where else to make profits, Luke? Because an emerging market is exposed to the oil market. Emerging markets, you like the bonds there?
Yes, absolutely. We were on last month talking about Mexico 100-year in sterling, and it's done very good relative. It's down a mere 1% versus the 2068 gilt, which is down 7.5% since last week. And I think if you think wider around Mexico, around Brazil, around a lot of the Latin American markets, there's opportunities there for economies to recover. And that's a good place to be. And there's signs of that coming through. I was sitting down with our emerging market debt team the other day, and they're finding plenty of opportunities in these countries, as we are as well, out in Singapore and out in Indonesia as well. But you're getting pushed out of your core markets into these more interesting bits.
This is the portfolio effect, more interesting. It's a dollar trade, though, isn't it?
Yeah, partly, definitely a dollar trade. And, you know, you're going to need some continuing movement higher in terms of dollar to support that trade. But that's where we think things are going.
Luke, it's been a great pleasure, as ever, seeing you this morning. Thank you very much indeed for coming and spending so much of your time with us here at Bloomberg. Luke Higmore, Senior Investment Manager at Aberdeen Asset Management.